Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, May 24, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we got a new closing high today. That's what it looks like to me, 240.61 on close. And to me, from a longer term perspective, and when I say longer term, I'm not talking about months or years, I'm talking about days and weeks. And so from a longer term perspective, I think this is the shot across the bow that could create a vacuum to the upside. However, I think the market needs to pull back first. And once that happens, and it doesn't have to happen, we can certainly get a vacuum to the upside. I talked about that the other day. However, I do think it needs to pull back first. We're a little bit overextended on a short-term basis. But once that happens, I think that this is the shot across the bow that's going to bring the higher prices into the fold. Now remember, and I haven't said this in a while, so it's apropos, that I talk about it today, which is the market's job is to make as many market participants, traders and investors, look like fools as much of the time as possible. So that being said, it looks like we're on a breakout, and maybe we just do break out and have a vacuum to the upside. That's certainly possible. But I think what happens is a day like today will begin to suck in some retail investors, and I think that's when the institutions pull the rug out and send the market down in a corrective fashion for a little bit, maybe a few days, maybe it's a week. And then at that point in time, we have a pullback that essentially builds the energy for the next phase higher. And that's what I'm favoring. That's what I think is going to happen. However, I do think today's close is a shot across the bow. Over 240.08 was my important number, okay? I said that a long time ago, that the market had to close above 240.08 in order to have higher prices coming. I think the higher prices are coming, but I do think there's going to be a pullback first. I know I'm talking out of both sides of my mouth. I get that. But that's the way I see it, and that's the way I'm going to play it. There are a couple of external factors that do play in. So tomorrow's Thursday, the following day's Friday, into a 3-day holiday weekend. Generally speaking, we're not going to see any kind of meaningful decline into a holiday weekend. That would be abnormal. Okay, the normal thing for the market to do is volume to leave the market, and you'll notice today the volume was 48 million shares. That's very, very light, and if you look down here at the bottom, and it's difficult to see by my color of, I guess this is, turquoise, this is challenging the lowest volume day of the year. In fact, it may very well be the lowest volume day of the year, and if it's not, it's pretty close. One way or the other, on light volume, what happens is it's very easy for the institutions to establish a buy program intraday that sets the market higher. And that's pretty much what happened in the afternoon after the phony Fed announcement, the phony Fed minutes. So what happens is the Fed has their meeting, and then they have minutes of the meeting, just as all organizations do. Board meetings and all that kind of stuff. Everybody has minutes, so they have a record of what happens. But the minutes really aren't the minutes of the meeting. It's not really what was discussed. It's what they want the public to believe. So whatever the minutes are, that's in a separate file. What they put out today is what they want you to think is the case, or what they want you to think was discussed. It's basically a cleansing of the minutes, and they give you a couple of snippets of what the net is that they want you to believe. And that's what was put out today. So the market goes up and it goes down. It has the small EKG that we always talk about, not a large one, a small one. The minutes aren't that big of a deal. Nobody's really even paying attention to the minutes because they're nonsense, for one, and number two, it's from something that already happened. So they're really a non-event, but the market does, take a little bit of a cue. So the market goes up and it goes down a few points here, a few points there. And then a buy program hits in and we close near the highs of the day, a little bit off the highs of the day, maybe 20, 25 cents off the highs of the day on the SPDR. And so that was it. 12 cents off the highs of the day in the SPDR. My fault. And so over the next 2 trading sessions, as long as the volume remains light, and we have every reason to believe it will, we're likely to get a lot of non-activity, a lot of sideways markets. Unless we have some kind of an event that sends the market down or sends the market up, it's unlikely, but anything is possible before a holiday weekend. It's just hard to see large movements down or even up. We're likely to see the low volume float. So the SPDR was up 0.2% today on extremely light volume. Let's take a look at the IWM. Now what I find interesting is the IWM found resistance at the 20-period moving average, and that's one of the points that we mentioned over the last couple of days of overhead resistance. The 20-period moving average is overhead resistance. This consolidation area up here is overhead resistance. The 138.60 is a very important level that the market needs to close above in order to get anything going on the upside. It also represents a gap fill that was left open from the vacuum on the downside from last week. So the IWM remains the weaker index. So it was down 3 cents today. We'll call that flat. It's basically a scratch. But with the IWM not leading the market on the upside, and the transports, which we'll get to in a minute, not really leading the market on the upside, it's very difficult to see any kind of significant move higher from here. And this is one of the reasons why I'm saying what I said on the SPDR, where I just don't see the upside happening now, although I do see it as a shot across the bow. I just think we need to pull back first, and one of the things that's telling me that is certainly the IWM. Right now, at this point in time, it makes more sense to me that the IWM would need to jump over the overhead resistance in order to get through there. It's very, very difficult resistance right here with the 20, the gap fill, consolidation. There's just a lot happening in this general area. And as you can see, the IWM has been struggling, and it's essentially making a bear wedge pattern. Now, if you look at it like this, okay, the down day into the following day could be considered the down move. Okay, there's a vacuum in here that's left by the open gap. Okay, but this is essentially a bearish wedge pattern that just traded up into the 20-period moving average. The question is, are we going to move down, or are we going to jump the gap or power through the gap and move higher? It's very difficult to power through the gap, but we could jump above it. In order to do so, we would need some kind of an event to jolt the markets. When you look at the transports, it looks identical, other than the fact that we closed above this red candle high at 9,473 yesterday. Okay, but today we traded up into its 20-period moving average and backed off a little bit, put in a doji candle. It's not that meaningful. It's in the middle of a range, so I don't want to make anything out of it. The point is we're into, just like the IWM, a lot of overhead resistance. The same rules apply. We can jump over it, which will be much easier for the market to continue in a move upward than it will be in order for us to power through it during the day without some kind of an event. Same story, same deal. It looks very similar on the chart to the IWM. Essentially, nothing has changed from yesterday to today in the transports. Tonight I want to take a look at the XBD again, and the broker-dealers, similar to the transports, similar to the IWM. The difference between the broker-dealers and the transports is that it has not gotten above this red candle high. It's below the 50 and the 20-period moving average in a bearish wedge formation, and this will generally promote another move downward. So, as we know, without the financials, very difficult for the market to gain any traction on the upside. You need the financials to participate with any kind of a meaningful move to the upside. Let's dig in a little bit and look at some of the individual financial equities, and let's see what's going on, because there is something interesting out there, and I'm not sure we can make anything out of it just yet. But if we look at JPM, which is the largest financial that we've got here in the U.S., JPM was flat today. It was basically a scratch. So nothing going on the upside. Looks very similar to the XBD. A lot of overhead resistance. It's not really mirror imaging the SPDR at all. It's not even close. So there's trouble in the financials. We need to make sure that we're aware of that. Without the financials, very difficult. Bank of America, same pattern. Okay. Wells Fargo, Another big financial, okay? Basically the same pattern. You don't have the same big red candle that we just looked at, but it's basically the same candle underneath the moving averages. A lot of overhead resistance, nowhere near the highs, struggling a little bit. This is telling you, with lower highs, this is telling you something is amiss with these financials. The only one that powered up today was Goldman Sachs, and Goldman Sachs was up nicely, and it's running for this gap here, and there's a lot of consolidation. So you're going to run into a ton of resistance right here at this consolidation point, the 50-period moving average and the gap fill right here. But it did get above and close above its red candle high. So something else is going on with Goldman. With that being the case, you can expect over the next day or so to find some news coming out on Goldman. And usually the market is ahead of the news, and that's just the way it works. But then when the news does come out, then they cite, this is the reason why Goldman's up, and it'll be up that day when the news comes out, and they'll say, well, Goldman's up because of X, and I'm telling you in advance, expect a news event because something's going on with Goldman for it to be up 2% without the rest of the financials participating. Don't know what it is, haven't looked at the news, maybe something's out already. I should have looked before I mentioned that, but it doesn't really matter. I just want to look at the charts, and that's really all I care about. Since we just looked at somewhat of the bear case of why the market should run into resistance because of the financials and the IWM, let's look at the flip side. I think that's only fair. When we look at the NQ, we're at new I think we're at new all-time highs. Let me measure that. Yeah, we're at new all-time highs again, and we closed above this red candle high. That was 57.24. We're at 57.32 and a quarter. That's a sign of strength. Generally speaking, you would have a continuation move up from there. We'll see if that happens. That's a divergence from what I just said before, but I'm just looking at the charts. I'm telling you what I see, and what I see is the financials holding the market back, and I see the NQ, which is top heavy. That's why I don't use it as a leading indicator, but it's still powering forward. So there are some select stocks out there, specifically the large tech names, that are holding the market up. The breadth of the market is not great, meaning across the board, the entire market is not up. It doesn't look like the NQ. The breadth is poor overall. However, when you have an index that has a lot of stocks in it that make it top heavy, the Amazons, the Googles, the Apples, the Netflix, and some of the semis, the Nvidias and such, that holds this up, and it gives it a skewed look. It makes it look like things are better than they really are. They are good for the NQ, but it's not representative of the breadth across the markets. But nevertheless, you can't take anything away from the NQ. It is what it is, and it is at new all-time highs. When you look at the SOX, which is the Philadelphia Semiconductor Index, which is a leading indicator in terms of the tech names and also the overall market. A lot of folks use the semis as another leading indicator, and I obviously look at it each and every day. I don't necessarily hold as much weight on the semis as I do on the IWM and the transports, specifically the IWM, because the IWM is representative of a broad swath across the whole market, and that's why I like it. But when you look at the semis are strong, and that's indicative of the NASDAQ strength, so there are some names that continue to power forward. Again, the breadth is poor, but the semis are strong, so it is a divergence. But I wanted to bring it to everybody's attention. All right, that about covers the stock markets. We'll go over to gold. Gold continues to make a bullish consolidation pattern. To me, this is beginning to look like gold wants to go higher. Today, gold finished in a positive fashion. We remain above all the moving averages. Bullish consolidation pattern. If gold's going to break out, I think it's going to break out whether it be tomorrow or Friday. I won't be surprised. The first stop is 1272, and the next stop is for the gap fill. Your gap fill comes in at 1283.30. We don't need this anymore. If we begin closing hourly above 1265, they're going to make a run for the gap at 1283.30. Not all in one shot, but it could happen very quickly. Gold does have a tendency to move pretty fast. What would take the upside off the table? There's really two important areas that would take take the upside off the table. One would be getting below the 20-period moving average would be a negative sign. That comes in at 1243.6. And then if you closed below this green candle low at 1236.30, that takes the upside off the table. But right now it's a bullish consolidation pattern setting up for higher prices in gold. It's just very hard to see it another way. When you look over at silver, very bullish sign for silver also. Silver had this one down day. We powered forward again. It put in another, pseudo doji candle, but now again it's fighting the overbought condition, and silver looks like it wants to make a run for the 50-period moving average. We'll just call it 17.5. Could get as high as the 200-period moving average if we got that vacuum on the upside in gold. If we closed above 1265 on an hourly basis, then of course daily, then we'll get the up move in silver as well. Could get up as high as the 200-period moving average at 1785. So the metals look positive from where I sit. Looking over at crude oil, basically a flat day in crude oil today. Not much going on. We had a little bit of an up move, a little bit of a down move, but all in all, as far as crude goes, a relatively narrow ranging day, and finished down, we're down 18 cents as we speak. I still think we're close enough where they're going to want to get to and pierce through the 200-period moving average that comes in at 52.22. Wouldn't be surprised to see 52.25, maybe even as high as 52.5 if they really jam it up. 53, but I don't see more upside than that. Should stall out up in that zone. I don't see crude oil closing above the 200-period moving average without a pullback in the cards. The only way that would really happen is from here if we saw a pullback or a sideways bullish consolidation pattern. That would change that outlook. That would lessen the importance and the impact of the 200-period moving average. But if we got up in there, let's say tomorrow, there's not enough energy to get much above there and close above there. We would have to pull back first. Crude oil is overextended on a short-term basis, so it's going to need to pull back. But the 200 generally will act as a magnet, especially since we've gotten this close. It's going to draw crude oil up into it. Looking over at the bond market. Now here's our bullish consolidation pattern again. So we had a little bit of a down move yesterday, and that got wiped out today with an up move. So we've got a bullish consolidation pattern. Looks like we're ready for a breakout. We're getting in the time zone where we can expect this pattern to play out to the upside if it's going to play out at all. Now this pattern that we're seeing, we have an up move, we have sideways consolidation. The next up move would take us to about the old high over here, the recent high, maybe slightly above, maybe to the 155.20 that we had discussed previously. And I think this is worth mentioning again. I find it interesting that we have the spider at all-time highs, and we have the NASDAQ at all-time highs. Okay, we have the financials struggling, and we have the bond market making a bullish consolidation pattern, which means that if bond prices move higher, yields will move lower, and that would be a little bit unique at this point in time for yields to be moving lower, stocks to be breaking out to an all-time high. Something stinks, and one of these two breakouts, well, I'm not going to call bonds a breakout, but one of these two up moves is probably going to be proven in the short term to be false. Either bonds are going to break down and this bullish pattern is going to fail, or stocks are going to have to pull back as bonds are moving higher out of this bullish pattern, as I suspected, pull back, consolidate for a while, and then make that another push higher into the cycle high that should come over the next, month or so. So we'll certainly see how it all works out, but I find it interesting. Something is amiss, and something is going to have to get reconnected here to make more sense to me, at least. Looking over at the dollar, came back in to retest the 96.97 area. You'll notice we're sitting at 96.98. Find that a little bit funny. There's no irony. It is irony. It's no coincidence. That number is important to the market. It's no wonder they came to back test it. Markets like to backtest important numbers, important breakout areas. It's very common and normal market behavior to check back with a former important breakout or important number. And that's what I see happening today. We'll see what happens with the dollar. We should be finding low in the dollar, and we should find the dollar starting to head higher sooner than later. And with that, it's everything I wanted to discuss tonight. So we'll call it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.